So the exact strategy that created literally billions of dollars in wealth for Warren Buffett is it's based on an idea so astonishingly simple that you could probably explain it to a teenager in like 5 minutes.
Oh, easily. Yeah, without a doubt.
Right. And today we are pulling from this really fascinating analysis called the architecture of value investing. And our mission for this deep dive is to uncover the foundational strategy that completely altered the financial universe.
It really did.
Yeah, and it's a framework rooted in this single monumental book called Security Analysis, which was originally written by Benjamin Graham and David Dodd.
Right, which is, I mean, it really is the bedrock text for modern finance. Like, to understand its impact, you kind of have to look at what investing was before Graham and Dodd published this back in the 1930s.
It was basically the Wild West, right?
Exactly. The stock market was largely treated like a casino. People were essentially just gambling on ticker tape, relying on tips, rumors, and just sheer momentum.
Just guessing, basically.
Yeah, guessing and hoping. And security analysis introduced this framework that brought rigorous logic, mathematical analysis and psychological discipline to the whole process. I mean, it is the literal textbook that taught a young Warren Buffett how to look at value.
Okay, let's unpack this, because here is the central irony of this entire source text.
Okay.
The book that completely revolutionized the investing world, the specific strategy that built the massive Berkshire Hathaway empire, is basically just common sense disguised as high finance.
Oh, it absolutely is. But, well, as the historical record of the stock market proves over and over, common sense is extraordinarily uncommon when real money is on the line.
Right, yeah. People lose their minds.
They do. And that is exactly why the lessons from this analysis are so critical for you today. I mean, we are living in an era where millions of people are buying stocks based on, fleeting trends.
Oh, totally. The whole meme stock thing.
Yeah, they're buying based on the fear of missing out. That classic FOMO. They are making massive life-altering financial decisions based on social media hype, or a random post they saw online, or whatever a crowd of anonymous avatars is screaming about in some forum.
It is the meme stock phenomenon playing out on a daily basis. It's the whole to the moon mentality where people are just throwing their life savings at a glowing screen purely because, a red line suddenly turned green and started moving up.
Right. And in that highly volatile, heavily gamified environment, this deep dive offers a timeless, rational antidote.
Which we desperately need.
Exactly. This analysis isn't just about the mechanics of making money. It is really a psychological masterclass in learning how to separate actual tangible worth from crowd-driven noise.
Right.
It's about developing the mental armor required to look at a chaotic, hyper-emotional marketplace and, clearly see the underlying reality.
So to understand Buffett's success, our sources point out that we first have to ruthlessly strip away all of that modern noise.
All of it.
We have to completely ignore the glowing screens, the flashing arrows, the push notifications on our phones, and fundamentally redefine what we are actually buying when we hit execute on an investing app.
Right, because the core premise of value investing, the absolute foundational idea in security analysis, is that a stock is not a number bouncing around on a screen.
Even though that's exactly what it looks like.
Right, that is the great illusion of the modern market. A stock represents literal, legal ownership in a real, living, breathing business.
And the analysis provides this really grounded analogy of owning a small local coffee shop to explain this.
I love this analogy.
Yeah, it's great. So imagine you actually own a cafe in your neighborhood. You know your head barista's name. You know exactly how much your wholesale espresso beans cost per pound. You see the regulars coming in every morning.
Yeah, you know the exact profit margins you're running at the end of the month.
Exactly.
Because you are deeply connected to the operational reality of that business. Its supply chain, its overhead, its cash flow, its customer base.
But let me push back on this, because a stock isn't a physical coffee shop.
Okay.
I can't walk into a massive multinational tech conglomerate and check the espresso machines,
Right, you can't just open the back door.
Exactly. So if someone walks into my hypothetical cafe tomorrow morning while I'm wiping down the counter and offers me a wildly lower price for my thriving business, just a completely irrational lowball offer, I wouldn't panic and sell.
No, of course not.
I would laugh them out of the building. I know my profits, I know my customers, I know my long-term growth. So why do we completely lose this basic business logic the second we interact with a digital stock?
What's fascinating here is the psychological mechanism of abstraction.
Abstraction.
When you look at an investing app, you are completely abstracted away from the reality of the business. You don't see the factories, the patents, or the balance sheet. You just see the price fluctuating.
Just a chart going up and down.
Right. And Benjamin Graham warned about this abstraction decades before smartphones even existed.
Wow, really?
Yeah. He observed that humans naturally want to buy during hype, like when the price is skyrocketing and social proof tells them it's safe, and they want to sell during fear when the price drops. The ticker tape fundamentally strips away the mindset of a business owner and replaces it with the mindset of a gambler reacting to a slot machine.
I struggle to see how a regular person overcomes that, though. I mean, if you are a business owner, you would theoretically want to buy more of a great business when it was on sale.
Exactly.
But the screen abstracts it so much that a dropping price feels like a penalty, not a discount.
Well, think about your coffee shop again. If a competitor's highly profitable shop across town suddenly went up for sale at a 50% discount, maybe the owner had a sudden personal emergency and needed cash immediately, right?
Right.
You would recognize the inherent value and buy it. You wouldn't say, oh, the asking price is down, the coffee must suddenly taste terrible.
Yeah, that makes sense.
But in the stock market, when prices drop due to macroeconomic panic, people automatically assume the underlying business is failing, even if the company is perfectly healthy and churning out record profits.
Because they're just looking at the red line.
Exactly. They invest emotionally, relying entirely on the crowd's reaction rather than investigating the business's actual reality.
Okay, so treating stocks like physical local businesses completely shifts the paradigm. But if we are adopting this business owner mindset, how do we actually calculate what these massive companies are worth without getting swept up in the crowd's feelings?
Right. The actual math.
Yeah, if we aren't using the stock's current price as our gauge of value, what are we using? Because our sources explicitly state we have to look at the math and redefine what risk actually means.
Well, this brings us to the bedrock concept of the entire philosophy, which is intrinsic value.
Okay.
Intrinsic value means the true, objective, mathematical worth of a company. It is not what a subreddit feels the company's worth on a Tuesday afternoon.
Right, definitely not that.
And it is not what a charismatic CEO claims it will be worth in 10 years.
But how are we actually defining and calculating that, though? Because intrinsic value is a term thrown around on financial TV all the time, but it usually just sounds like corporate jargon. Let's get into the mechanics of it.
Yeah, let's do it.
Yeah.
Graham was incredibly strict about this. To find intrinsic value, you evaluate concrete, measurable factors. You look at the company's physical assets like real estate, machinery, inventory.
Tangible stuff.
Exactly. You look at their cash reserves, you look at their historical proven earnings, not speculative future projections, and you look at their debt.
Okay.
Graham favored a concept called liquidation value. Essentially, if we had to close the business down tomorrow, sell off every single desk, factory, and patent, and pay back every single bank loan, how much actual cash would be left over?
Oh, wow.
Yeah, that gives you a hard floor for what the company is truly worth.
So the only way to find that intrinsic value is by ruthlessly dissecting the financial statements.
Exactly. Great investors don't read press releases. They read balance sheets, 10K reports, debt schedules, and cash flow statements.
Because those can't really lie.
Right, because numbers don't possess emotions.
Yeah.
You can have a flashy company that looks incredibly exciting online. Maybe they're involved in artificial intelligence. They have a sleek brand. There is massive media buzz. But their financials are a total horror show.
Like they're losing money hand over fist.
Yeah, they're drowning in short-term debt, they have massive operational costs, and they are bleeding cash every quarter.
While on the flip side, you have the aggressively boring companies.
Yes, the boring ones.
Companies that manufacture commercial HVAC systems or manage industrial waste or produce corrugated cardboard. They will literally never trend online.
Never.
But they might have zero long-term debt, massive cash reserves, and compounding profits that grow by 8% every single year. And the source text points out that these boring companies routinely become incredible investments, specifically because they are systematically ignored by a market that is addicted to flashier things. Absolutely.
Let's ground this in the math provided by the source.
Yeah.
Imagine doing all that balance sheet homework and finding a company that, based on its assets and earnings power, has an intrinsic value of exactly $100 billion.
Okay, 100 billion.
But because the market is currently panicked about a recession or just distracted by a shiny new tech IPO, the stock market is currently pricing the entire company as if it is worth only $70 billion.
Right. And that $30 billion gap is the entire mechanism of value investing. You are effectively buying a dollar bill for 70 cents.
Which sounds like a no-brainer.
It is. You buy excellent, fundamentally sound businesses when they are significantly undervalued by the market, and then you just hold them. You wait for the market to eventually recognize financial reality and correct the price upward.
Here's where it gets really interesting, because the source material uses this exact scenario to completely flip our standard understanding of risk on its head.
Yeah, this is a big one. I have to play devil's advocate here for a second. Anyone who has taken a basic finance class is taught about modern portfolio theory. We are taught that risk equals volatility, beta.
Right.
The stock bouncing up and down wildly. If a stock's price moves around a lot, it is inherently risky, but Graham violently disagrees with that. The text says real risk is actually just overpaying. How does Graham justify ignoring volatility?
Because Graham viewed volatility merely as the crowd's emotional reaction, not a reflection of business reality.
Okay.
Let's go back to our example.
Oh.
If you own a business intrinsically worth $100 billion, and tomorrow the market panics and prices it at $60 billion, and the next week it bounces to $80 billion, that is high volatility.
Right, massive swings.
But if you have done the math and you know the liquidation value and earnings power equal $100 billion, those wild price swings don't change the underlying reality of the business.
Because the coffee shop is still selling coffee.
Exactly. The factories are still running. The customers are still buying. You haven't lost a single penny unless you panic and sell at the bottom.
But if I buy a fundamentally weak tech company that is intrinsically worth only $20 billion, but I get caught up in a massive hype cycle and I pay $50 billion for it.
You have locked in a permanent loss of capital. That is real risk.
Wow.
Yeah, the underlying business simply cannot generate the profits required to ever justify the $50 billion you paid for it. Eventually, the hype will fade, the market will realize the company only makes $20 billion worth of value, and the price will crash.
And you're just left holding the bag.
You don't recover from that. Disciplined investors mitigate this true risk by demanding a mathematical buffer. Graham called it the margin of safety.
Which is the $30 billion gap from our previous example.
Precisely. Graham borrowed the concept from engineering. If an engineer is building a bridge that needs to hold a 10,000-pound truck, they don't build it to hold exactly 10,000 pounds.
They build it to hold way more.
Right, they build it to hold 30,000 pounds. That 20,000-pound difference is the margin of safety. In investing, it is the difference between the intrinsic value and the discounted price you pay.
So it's like a cushion.
Exactly. It protects your capital against your own miscalculations, sudden economic depressions, or just plain bad luck. If you strictly demand a massive margin of safety, you drastically insulate yourself from risk, regardless of how aggressively the stock price jumps around from day to day.
Okay, so the mechanics of this are crystal clear. You analyze the balance sheet, you calculate the liquidation value and earnings, you find a massive margin of safety, and you buy. The math makes total logical sense.
On paper, yeah.
But if it is this straightforward, why does the source text emphasize that this is where the vast majority of investors completely fail? If I can find the $30 billion gap, why can't Wall Street?
Oh, Wall Street can find it. But they are playing a totally different game driven by human psychology. The math is simple. Surviving the psychological warfare of the market is grueling.
I want to dig into that because the text says value investing is agonizingly slow. Like, the market can sometimes take 3, 4, or 5 years to recognize a company's true value and correct the price.
Yeah, easily.
And we live in a culture that demands instant gratification.
And that is the Achilles heel for institutional and retail investors alike.
How so?
Well, a retail investor might correctly identify an undervalued company, buy it, and then nothing happens for 2 years.
Yeah.
Or worse, the price drops another 10%.
That would be brutal.
It is. They endure the daily pain of logging into their account and seeing red numbers. They lose patience, they capitulate and sell, and then a year later, the market finally corrects and the stock skyrockets.
Right.
Wall Street professionals face the same pressure, just from their clients demanding quarterly returns. Neither group can afford to wait.
This requires an almost unnatural level of independent thinking.
Yeah.
I mean, you have to be willing to not just ignore the herd, but to actively step in front of it. The text spells it out. Great investors become deeply cautious when everyone else is greedy, and they aggressively look for opportunities when everyone else is paralyzed by fear.
Which violently contradicts every evolutionary instinct hardwired into the human brain.
Yeah, we're pack animals.
Exactly. Think about our neurobiology. Humans survived on the savannah by finding safety in the herd. If everyone in your tribe suddenly starts running away from a watering hole, your instinct is to sprint with them. You don't stand there and analyze the situation.
You just run.
Right. If everyone is running towards something, you join them. The stock market hacks that exact fight-or-flight response. Value investing demands that you stand completely still when the herd runs in panic and walk toward the exact thing the herd is fleeing from.
So what does this all mean? Let me zero in on an exact quote from the text, straight from Warren Buffett. He states, "The stock market is a device for transferring money from the impatient to the patient."
It's a brilliant quote.
Is the stock market essentially just a massive psychological waiting game, testing who blinks first?
If we connect this to the bigger picture, yes, that is arguably the most accurate definition of the stock market ever articulated. The surface mechanics involve buying and selling, but the underlying engine of the market is human emotion. We often view patience as a passive trait. We think of it as sitting around doing nothing, which sounds incredibly boring. But in the context of investing against a chaotic crowd, patience is an active, aggressive strategy.
I see what you mean. Waiting isn't doing nothing. It is actively enduring the cognitive dissonance of telling thousands of screaming people that they are wrong and you are right.
It requires immense mental stamina. This specific psychological discipline is what allowed Buffett to build his fortune during catastrophic market crashes. Think about the crash of 2008 or the brutal bear markets of the 1970s.
When everyone was losing everything.
Exactly. When the market crashed, Buffett didn't experience the panic that everyone else did. He looked at the exact same data, but he saw a department store full of world-class businesses suddenly marked down by 50%.
Because he already knew the intrinsic value.
Right. He had the cash ready because he refused to overpay during the preceding boom times, and he had the psychological fortitude to buy aggressively when there was literal panic in the streets. Is the ultimate triumph of discipline over instinct.
It fundamentally demystifies the whole aura of Wall Street, doesn't it?
Completely.
We are conditioned to believe billionaires have some, proprietary algorithmic black box or secret inside information. But according to this deep dive into security analysis, the secret is startlingly mundane.
It really is.
You do the agonizingly boring accounting homework to find the intrinsic value, and then you exert ironclad emotional control to stick to the plan when the market tries to terrify you.
It is remarkably simple to understand, yet extraordinarily difficult to execute in practice.
Because fighting your own neurochemistry is the hardest battle there is.
Exactly.
Let's summarize the overarching narrative we've extracted from our sources today. While security analysis is famously a dense, textbook-level read, its core philosophy is elegant and unyielding. To succeed, you must adopt the mindset of a business owner, not a gambler. You must rigorously study the actual financial health of a company to calculate its intrinsic value, completely ignoring market hype and volatility.
Right.
You must demand a massive margin of safety to protect your capital from unforeseen disasters. And above all, you must cultivate the aggressive patience required to let the math prove itself out.
Those are the exact principles that shaped the most successful investors of the last century. It isn't about getting lucky on a hot stock tip or, timing a market trend perfectly.
Yeah.
It is about understanding the fundamental value of an asset better than the panicked crowd and having the sheer discipline to wait for reality to assert itself.
Which brings us to a really compelling final thought for you to take away from this deep dive.
This raises an important question. Our source material makes a profound observation that boring companies sometimes become incredible investments simply because the crowd is too distracted by flashy online hype to see their true worth.
Yeah, the corrugated cardboard companies.
Exactly. The market systematically undervalues the reliable, the steady, and the boring in favor of the exciting and the flashy. So if that dynamic is objectively true in the financial markets, it begs the question.
What else is it true for?
Right. What other areas of your life, your own skills, your daily routines, your relationships, are you drastically undervaluing simply because they don't look exciting on a screen?
Wow, that is a phenomenal question to chew on. Where is the hidden intrinsic value in your own life that you are currently ignoring? We want to thank you for joining us on this deep dive today. Keep studying the underlying mechanics of the systems around you, keep questioning the hype of the crowd, and keep looking for that true intrinsic value.